When you put your money in your bank account, you're probably thinking that it's just sitting safely in a locker with your name on it, right? Well, what if I told you that's not what actually happens? Hey everyone, welcome back to Fun Me Not, and today we'll be discussing how the money actually moves from the moment you deposit it in your first bank account. We would often deposit our money and forget what happens later, but there's a whole big story behind it. Your bank records your money as a liability, which means it owes you what you give it. They're not actually keeping your money aside, but in fact are using it. Your deposit is basically becoming their raw material. They take a big chunk of your money and start giving loans, investing, earning interest, funding businesses, and a lot more things. That is exactly how banks make money. But don't freak out. You can still withdraw your money whenever you need it. By logic, all banks do not need all depositors' money at once. There's a whole system that works together. A normal person would typically open something called as a savings account for their daily finances. When it comes to being an employee, they have a separate account called as a salary account where they get their monthly paychecks. If you're into specific investments or savings, you have a fixed or a recurring deposit account accordingly. And you must have heard of demat account or current accounts as well. These are for trading and for business needs respectively. We as students can also have a student account. Seniors can have their own account. This was just the one way. You depositing your money and it goes to the bank. But what if you need your money to send it to someone else? Or what if they need to send it to you? Well, now cases have been pretty easy considering that we have digital payments, UPIs, and other methods of payment. Traditionally, sending money to someone belonging to the same bank as yours was very easy, but when you're sending money to someone who is not at your bank or outside of it, because obviously you choose your bank according to your specifications while they might choose another one. Your bank has to pay their bank. Depends on who is sending the money to whom. But it's not with actual cash. It is with their reserves. Basically, each bank has a certain amount of money reserved at the central bank, which in a way can be taken as the king of all banks. Think of reserves as a bank's bank account to the central bank. When you send money to someone outside of your bank's reserves go down while the other bank's reserves go up. Pretty simple. This is exactly what keeps the system fair and trustworthy. Without the central bank supervising all of this through their reserve specification, banks would not trust each other. So you could consider reserves as the lifeline of the whole banking system. And every country has their own central bank. India has RBI, which is the Reserve Bank of India, while other countries have Bank of England or Fed, etc. CRR, which is the cash reserve ratio, varies from country to country as per their central bank. Now, this was you making payments to your friends. But what if you want to pay the government? Why would we pay the government and how does that happen? Taxes. Paying taxes is almost a very normal routine for every citizen of a particular country. When we are given a certain amount to pay, it is usually inclusive of taxes. So you never know whether you're paying it or not, or how are you paying it, or what's happening thereafter. Your bank balance obviously goes down. The government's balance at the central bank goes up. And yes, central bank holds the government's bank account. Government spending goes into paying salaries, building infrastructure, funding education, healthcare, or several political campaigns. That means in a country like India, every single rupee spent by the government goes back into the economic system as someone's income. And that is what makes India have something called as a circular economy. And if the government needs more money, they do what every other person would do in need of it: borrow. And they do it through government bonds. Banks and investors buy these government bonds and get interest as return. Money is literally moving from private accounts to government's account and all the way back in. This is exactly how countries fund themselves. Now, by this time, I'm pretty sure you must have observed that the core entity behind all of these operations is the central bank. Central bank has monopoly to issue and print notes. But that is not just what they do. They control money and its supply through open market operations or OMPs. OMPs is the buying and selling of government bonds or government securities and accordingly adding it to the banking system or removing it. This is what affects interest rates, inflation, lending, and the overall money flow. This is how monetary policy works. Now, what if you want to transfer your money to your long distance friend living abroad? The truth is, your country's bank does not have an account in every other country. So it uses correspondent banks, big global banks, as middlemen. These banks hold two types of accounts mainly: nostro accounts and vostro accounts. Nostro accounts basically has your bank's money held abroad, whereas vostro accounts has the foreign bank's money held here. This is how SWIFT payments, remittances, foreign transfers actually work. If we try to put it all together, you will observe that money moves through a chain. It is you to your bank, to the central bank, to the government, and to you all the way again. Internationally, the same thing happens, but it involves correspondent banks. If you want more such economic and financial breakdowns, make sure to hit the subscribe button and I shall bring them to you. See you in the next one.